All right, let's dive right in. Today, we're going to decode a really important accounting standard, IFRS 11. Think of it as the official rulebook for when companies team up. And trust me, understanding this is the key to seeing what's really going on behind the scenes of any business partnership.
So this brings us to the big question, right? When companies join forces on a project, how does that actually show up on their financial statements? IFRS 11 is designed to answer exactly that, giving us a clear framework for what the standard calls joint arrangements. So, before we get any deeper, let's make sure we're all on the same page. What exactly is a joint arrangement according to the rules? Let's get the official definition.
Okay, so the standard is super specific here. This is not about some informal handshake deal. For it to count, you need two things. First, there has to be a contract. And second, and this is the really crucial part, that contract has to set up something called joint control.
And this idea of joint control, honestly, it's everything. It is the absolute gateway to understanding IFRS 11. So let's zoom in and really break this concept down.
Here it is, straight from the standard itself. And there's one phrase in there that is just critical: unanimous consent. See, this isn't about having a majority vote or being the biggest shareholder. It means the key players sharing control all have to agree. No single party can just make a decision and run with it.
And this slide just illustrates it perfectly. Look at the left side. Party A has 50% and B has 30%. If the contract says you need a 75% vote to do anything important, then A and B have to work together. A can't act without B and B can't act without A. That right there is joint control. But now look at the right. A can get to that 75% by partnering with either B or C. Because there's no single specific group that has to agree, there's no unanimous consent. So that is not joint control. See the difference?
Okay, so once you've confirmed that, yep, joint control exists, you hit this massive fork in the road. This is the central decision point in IFRS 11, and every single joint arrangement has to go down one of two distinct paths.
And this is that big decision. It all boils down to the rights and obligations of the partners. Are you dealing with a joint operation or a joint venture? In a joint operation, the partners have direct rights to the individual assets and are on the hook for the individual liabilities. It's like you own your specific share of the factory and your share of its loan. But in a joint venture, the partners only have a right to the net assets, basically the profit or loss at the end. You have a claim on the final score, not the individual players on the field.
So, the big question is, how does a company figure out which path they're on? What's the process for figuring out their rights and obligations so they can classify the arrangement correctly?
Well, luckily, IFRS 11 gives us a pretty clear four-step guide. You start by looking at the structure and the legal form, but then you zero in on what's usually the most important piece of evidence, the contract. And if things are still a little fuzzy after all that, you then look at any other facts and circumstances floating around.
You know, the contract is usually the biggest giveaway. This table breaks it down perfectly. If the contract says that the parties have direct rights to the assets and are directly on the hook for the debts, you're almost certainly looking at a joint operation. But if the contract says the arrangement itself owns the assets and is responsible for its own debts, and the creditors can't come after the partners, well, you're probably headed down the joint venture path.
So, we've done all this analysis. We've figured out what type of arrangement it is. Why does this all matter so much? Well, it all comes down to the final destination, how it looks on the company's financial reports. And believe me, the difference can completely change how you see a company's financial health.
The accounting result is night and day. For a joint operation, you have to report your direct slice of every single asset, liability, revenue, and expense on your own books. This can make your company look a lot bigger, but it can also make it look like you have a lot more debt. For a joint venture, it's way simpler. You typically just have one single line on your balance sheet, investment in joint venture. That one number then gets tweaked over time based on your share of the profits or losses.
All right, let's do a quick recap. A joint arrangement needs a contract, and critically, it needs joint control, which means everybody has to agree. From there, it's one of two things: a joint operation, where you have rights to the specific assets and liabilities, or a joint venture, where you only have rights to the net result. And that choice completely changes the look and feel of a company's financial statements. So ultimately, IFRS 11 gives you this powerful new lens. It forces you to look past the flashy press release and really analyze the rights and obligations underneath. So next time you read about two big companies teaming up, you'll be able to ask the right questions and figure out what the true financial story is.